when you say, diversify your portfolio, what diversification does, if it's done correctly, it should increase your total return without increasing your risk. Most people don't really understand diversification. I run into people all the time. They go, I'm highly diversified. I've got 50 different stocks in 10 different sectors, technology, consumer non-durables, services, mining, et cetera. I'm highly diversified. And I say, no, you're not. You may have 50 stocks, but you have one asset class, which is stocks. And they become highly correlated in certain conditions. So yeah, you may have a lot of different stocks, fine. But if the stock market's going down, they all tend to go down together. If it's going up, they all tend to go up together. You're not really diversified if you're in a single asset class. Real diversification means having numerous asset classes that are not highly correlated to each other. So have a slice of stocks, absolutely, by all means. Have some government bonds. I like, for in the American investor, a lot of global investors, in fact, 10-year treasury notes. But Australian government bonds for the Australian investor, et cetera. Have some land, have some real estate, have some venture, have some so-called alternative assets, hedge funds. If you can get in, they can be hard to get into, et cetera. Venture and natural resources, oil, energy, water, and then some gold and some silver. So that's real diversification, because gold will not correlate to stocks. Sometimes it does, but often they move in opposite directions. Gold doesn't. Gold correlates to bonds a little bit, but then you've got to throw in inflation, which helps gold and does not help bonds, and so forth. So what I just described. Oh, by the way, I forgot to mention a significant slug of cash, maybe as much as 30%. And I actually call it the barbell portfolio. So barbell, you got two heavy ends and a connector. So over here are your deflation hedges, and your deflation hedges would be bonds, utilities, and then you have your inflation hedges, and they might be, a normal stock portfolio, gold, et cetera. But cash is in the middle. Cash is the thing that connects the two. And cash has a couple of interesting properties. But people say, why would you have cash? It has no yield. Well, it has a very low yield. There's no question about that. But in a deflationary environment, which you cannot rule out, and I'm sure we'll talk about inflation in this interview, but you can't rule out deflation. In deflation, cash can be your best performing asset, because the nominal value is pretty much unchanged, but the real value goes up because every dollar is worth more in a deflationary world. The other thing that cash does is the exact opposite of leverage. A lot of the assets I mentioned, I would include stocks, stocks, bonds, and hedge funds and others, and gold for that matter, they're volatile. They have some volatility. Cash has zero volatility. It's just cash. And so what it does is it reduces the volatility of the overall portfolio. So you can have volatile assets on either end of the barbell, but cash kind of damps that down a little bit. It helps you sleep at night. And then the third thing it does, and this is not very well appreciated, cash gives you optionality. It has embedded optionality. So we live in an uncertain world. That's kind of obvious. But how deep is the uncertainty? How long will the uncertainty go on? We don't really know. But so what that means is if you place your bets, you say, okay, I really want to get into bonds, and I think there's a place for bonds. You get into bonds, and all of a sudden here comes the inflation. Those bonds are going to do very poorly. If you get into stocks and here comes a recession, the stocks are going to do poorly. So these bets can be good bets, but it can also be a mistake. Or you get into a private equity fund, can do very well, some have, but it's completely illiquid. Don't expect to get your money back early from Henry Kravis. He won't give it to you as you're locked up for 7 years. So the point is, the purpose of cash is, as we get more clarity, as some of these things, pardon me, Fed policy, central bank policy, inflation, deflation, the new COVID variant that's running around, this Omicron. As we get more clarity on these things, the person with cash has the optionality. You can pivot. If all of a sudden inflation comes in way higher than expected, you can go buy some gold. But if deflation appears, you can buy some bonds. So you preserve that. So think of cash as it's kind of an at-the-money call option on every asset class in the world. That sounds like a pretty valuable option. Well, that's what cash gives you. So a big slug of cash in the middle, maybe as much as 30%, just so that you can reduce volatility and be nimble. But But real diversification is going to be stocks, bonds, alternatives, venture, hedge, natural resources, cash, gold. They're all going to be in the portfolio, and that will perform well in every state of the world. Some will do better than others, but that's the point. That's what diversification gives you. But since 2010, central banks in the aggregate have been net buyers, and that buying is accelerating. So what does that tell you? It tells you that the most knowledgeable players in the world are adding gold to their reserves because they consider that a prudent hedge to the US dollar, if you have US dollar inflation, or to collapse the confidence in central bank currencies generally, or they're just saying, hey, we're part of the club. When people talk about the price of gold, and I'll just use US dollars as a benchmark because it's a good global benchmark. It could be on Australian dollars or any currency. People say, well, gold went up, and then they say gold went down, but gold really didn't do anything. Gold is an element. What changed was the dollar price. That's what people mean. When they say gold went up, they mean the dollar price went up. And if they say gold went down, they mean the dollar price went down. But what does it really mean? Is that telling you something about gold, or is it telling you something about the currency? And I would say when the dollar price of gold goes down, that means the dollar got stronger. Each dollar buys you a little more gold. And when the dollar price of gold goes up, I would say the dollar got weaker because each dollar buys you a little less gold. When you translate it into weight, I always think about gold by weight. That's why I keep talking about tons and so forth, metric tons. So fluctuations in the dollar price of gold tell you more about dollars than they do about gold. It tells you about the strong dollar and the weak dollar. So as the dollar price of gold goes up, what it means is that the dollar is getting weaker. Now, so if you want to know the dollar price of gold, just do a long-term forecast on the currency, and you'll get to the dollar price of gold very quickly. So when you say, is gold a good asset? Is it a good diversifier? Is the price going up in the long run? Great questions. And the way I think about it is, well, what's going to happen to the dollar in the long run, up or down? Well, what's the history of all central bank currencies? What's the history of all fiat currencies? What's the history of inflation? They all go down over time, not all at once. And that's another source of confusion because people look at, well, the dollar-euro cross rate, or they say euro to dollar cross rate, is the most heavily traded liquid, foreign exchange cross rate in the world. So, and in the past, I would say 2 months, a little more, the euro has fallen from about $1.20 to today it's about $1.13. That's a significant decline in the value of the euro and a significant increase in the value of the dollar. So a lot of times when people say the dollar is stronger or weaker, they're actually not thinking about gold along the ways we just discussed. They're thinking about some dollar index. But if you peel back the layers of the onion for every index, Dow Jones, Bloomberg, Fed, it's all basically the euro-US dollar cross rate. So yeah, there's some Canadian, Australian, and yen and sterling. There's some other currencies in there, but the euro is the lion's share. So all these indices are really euro-dollar cross rates. So when people say the dollar is stronger, well, it's another way of saying the euro is weaker.